Holy smokes, we got a lot of color from Elon Musk last week from the Tesla earnings call, earnings report, and quite frankly, what we saw in the stock movement. I don't think anybody can argue that movement was insane. In fact, historically, it was insane. The largest move ever in the last 10 years for Tesla stock in just one day, up 22%. Really incredible. And when you look at the numbers were rightfully so incredible. But in this video, we're going to go into detail. We're not only going to talk briefly about what we heard from the actual earnings and earnings calls and some of the numbers, but we're actually going to dive into the valuation of the company. We're going to talk about what is a fair price for the company today in 2026 and 2027. Is it fair to include Robotaxi or not? And what do the numbers look like if we do include Robotaxi? Let's do that, as well as speculate on what are these lower cost vehicles that are going to be introduced in 2025. Let's talk about all that in this video. But first, did you know, and this is just a fun fact, and it's about Tesla. Did you know that in 2014, Tesla introduced convertible bonds that paid just 0.25% per year in interest? People might ask themselves, who the heck would invest in a convertible bond that just paid 0.25% in interest? Like, why even pay interest at all? And it's because convertible bonds are actually really amazing. They give you the opportunity to participate in an upside with yield, and you get preference in liquidation. In fact, take a look at this Forbes article here that shows you in 2021, when this article was written, these convertible bonds converted to shares worth 800% more than what people invested in those convertible bonds for. So it really goes to show that these long-run bets on Tesla, they do tend to pay off. So congratulations to the people who made a lot of money on those convertible bonds, and hopefully that continues for the long-term future for Tesla. If you haven't heard yet though, I did take inspiration from Elon Musk and exactly this right here. We created convertible bonds over at HouseHack. That's my startup. If you haven't heard of them yet, go to househack.com. You can learn all about them. It's a 5% convertible bond, which means you get paid 5%, not 0.25%. You get 100% of the stock upside with downside protection, and you get paid interest on a monthly basis. It's pretty awesome. Go check it out over at househack.com. We're also running at a Q4 annualized profit, which means everything we raise goes into what we do best. Wedge deal real estate. And yes, while we're no car company, I think we're a killer real estate company. And yes, we use AI in our work as well. You've all seen my wedge finder, and it's awesome. With that, let's hit some of the numbers. Okay, adjusted EPS beat 20%. This is remarkable. Tesla's not generally known for beating and then beating by this magnitude. Amazing. The adjusted earnings per share were great. 72 cents versus 60 cents. Remember, adjusted usually adds back in things like stock-based compensation, but still 72 cents versus 60. It's a 20% beat. Amazing. And margins, honestly, fantastic. Excluding credits, the market was expecting a 14.9% automotive gross margin, and we ended up getting 17.1%. Like, I'm just stumbling over those words because it's so good. Now, I estimate that about 1% of that was likely due to enabling full self-driving on the Cybertruck. I think a lot of the early Cybertruck adopters were anxiously waiting for FSD, and you probably almost have a 100% take rate on FSD for the Cybertruck early adopters. These are like your mega Tesla fans. So I would bet that about 120 basis points of that beat was due to other aspects, and about 100 basis points was because of Cybertruck FSD enablement, which does mean there were still cost improvements from battery costs coming down or better manufacturing efficiency, the Cybertruck turning to gross profit as opposed to last quarter being a gross loss. This is pretty good. So congratulations. This is really good. This means now a new vehicle like the Cybertruck that is so unique to build and so unheard of, quite frankly, is actually creating a profit for Tesla on every single vehicle that they make from the Cybertruck. That absolutely impressive. In fact, in the last quarter Tesla earnings report, if you look at my earnings video, I say, you know what? When you remove the Cybertruck, the Tesla margins are actually pretty good. And the reason I removed the Cybertruck is because it was still a low sort of volume vehicle. The fact that it's already at gross profit and now it's contributive, whew, that's freaking amazing. Let's go. This is really good. Also, in the prior reports, I was a little jaded that they weren't actually going to fully build out this semi-factory facility. And at this point, at least, it looks like they are actually walls up and prepping out the semi-truck factory. So congratulations, Tesla. These are very good things. Now, not everything is good, but these so far are very good things. We're getting up to 50,000 H100 chips, NVIDIA chips online by October. Although Elon makes it clear that we're not really compute constrained here. We're actually more, and this was sort of a humble brag, constrained by the lack of finding problems in FSD. In other words, Elon was basically like, yeah, we find problems so rarely with full self-driving that now we're kind of just sitting around going like where is a problem for us to solve? And I'm like, okay, that's a pretty clutch humble brag. I actually dig it. Megapack factory expected to ship Megapacks in Q1 2025. Just to give you perspective as to what that means, Lathrop produces about 40 gigawatts per year. Shanghai is expected to get to 20 gigawatts, which would be a 50% increase in the energy business for the Megapack side. And that's phenomenal. And the Megapack and energy business makes money. It is like, I mean, you're talking over 30% gross margins. We used to celebrate Tesla for having 30% gross margins on cars during the stimulus days. They have that in the batteries. It's so amazing that it is absolutely crushing Enphase to the point where Enphase is complaining about Tesla in their earnings calls. If you read the last two earnings calls from from Enphase, in both of the last two earnings calls, they are complaining about Tesla. They don't name them in the prior one, but they do in this one. But they reference Tesla in the prior one by going, an unnamed competitor. It's bad. Like, Enphase is getting smoked by Tesla. And it kind of makes sense. Like, if you're going to buy a battery, would you rather an Enphase battery or a Tesla battery? Like, oh, come on. Anybody watching this video is like, nah, man, come on. Give me the Tesla battery. Okay, that's peepee, okay? They got pricing power in that aspect. That's great. Now, obviously, with pricing power, you have to also consider valuation, which we'll talk about. But I have to say, this was pretty good. So then we got into some of the things where I'm like, okay, so we got the good out of the way here. And we get into the, okay, where are you going with this, Elon? So Elon forecasts 20 to 30% vehicle growth. And this is what I think is really interesting. He talks about no $25,000 car, that basically a $25,000 non-Robotaxi car will not happen. So he's officially 100% killed the $25,000 non-Robotaxi car. It's over. Now, that exactly aligns with what Reuters told us and everybody said was fake news. It's just fake news, Reuters back at it again or whatever. But he literally says right here, yeah, well, we're not making it. Okay, so however we want to look at it, there is no $25,000 non-Robotaxi car. Now, is it possible that the Robotaxi is the $25,000 car? Yes. In fact, that's what Elon says. He says the $25,000 car is the Robotaxi. That is the Robotaxi. Now, of course, they do plan to have more affordable models. Now, this is what I think is really interesting, because I'm thinking to myself, wait, so if you're not doing a $25,000 car and the $25,000 car is just the Robotaxi, then how are you going to have more affordable models? And let me show you this in the actual earnings call. So regarding the vehicle business, we are still on track to deliver more affordable models starting in the first half of 2025. This is, I think, probably people are wondering what they should assume for vehicle sales growth. And at the risk of, a rough estimate, we think it'll be 20 to 30%, blah, 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 blah. Okay, we think with our lower cost vehicles, with the advent of autonomy, something like 20 to 30% growth next year is my best case. Okay, all right. Let's unpackage this, because this is where things start getting a little bit nuanced, where you kind of have to put your Elon hat on a little bit and go, all right, what are you saying? Because the initial takeaway is, got it, no $25,000 Robotaxi vehicle, but you're gonna have new lower cost cars. Wait, did he say new lower cost cars? Now forgive me for being jaded here, but I want you to read this line right here. So regarding the vehicle business, we are still on track to deliver more affordable models. Oh, okay. With our lower cost vehicles with the advent of autonomy. Wait, hold on a sec. Is it possible then that what Elon is saying is we're gonna have the 25K Robotaxi, okay? That's gonna be on one side of the equation. And on the other side, we're going to have more affordable existing models. Notice he did not say more affordable new models. We've already seen Tesla vehicles lose 20% of their value, basically, based on just new vehicle price cuts in, well, frankly, this year, in 2024. That's a lot. That's a substantial amount of hits. And on top of that, you've got elevated inventory right now. So when you factor in elevated inventory, 20% price cuts, some on Wall Street literally are calling Tesla right now, quote, the worst auto brand in terms of resale value because of these price cuts and the likelihood of more price cuts coming. A lot of folks look at this and go, oh, we're just going to get a lot more price cuts. That's what we're going to get. So now this starts making sense. Okay, fine then. So if the more affordable models are not new models, they're just existing models that are going to be cheaper, then if you're potentially in the market next year for a Model 3 or Model Y, you should potentially expect lower prices next year. Now, that doesn't necessarily have to be a bad thing for Tesla, because a lot of folks expect that Tesla is going to continue this 30-day free trial push, where every time they have a new software update, they give you a 30-day free trial on FSD. They try to hook you into FSD, and then they try to get you to fork over $8,000 to pay for FSD. And frankly, it seems to be working because their margins are going up, and I have to give them credit for this. They are converting people. And you know me, like, FSD is good. I've been using FSD since 2017. Do I think it's ready for full autonomy? No. Are there still bonehead things that happen? Yes, but they happen further and farther between every single time I use it. And so I have to give credit where it's due. And congratulations, like it is going great. So I think this 20 to 30% vehicle growth, even though we didn't really get color on where this vehicle growth is coming from, I do not think there is a new model. I actually think it's just the existing models with lower prices and potentially more credits from, whatever, tax credits, state credits, you name it. So we'll see. Now, obviously, the election could have some impact on that. We'll talk about this. But I do think there was a lot of confusion around this. And I think that my thesis clears this up, because Elon also makes it very clear that the non-Robotaxi $25,000 car would be pointless, that the future is autonomous. And frankly, Elon is right when he says you should not invest in Tesla if you believe that autonomy is not going to happen at Tesla. In other words, the only reason to invest in Tesla is if you actually believe robotaxis and full autonomy are going to happen. Now, I personally am of the mindset that you don't actually need to get to full autonomy to make Tesla extremely profitable. You just need everybody using FSD, and then you need to print as many affordable vehicles as possible, which maybe that's what Elon is also doing. He's saying, like, let's just cut the price on the 3 and Y as much as possible to print as much of those suckers as possible to get as many FSD revenues coming in as possible. In the meantime, we're just going to develop the 25K car. And honestly, to that, cheers. I don't really think you need a new model. I mean, don't get me wrong, I'd love a larger model, but I don't think you're going to get it. I think it's all going autonomy. So don't expect a new model from Tesla. That's it. Any of the new models are just solely autonomous. That's my take. So let's touch on a little bit more. Obviously, he mentioned things like energy is on fire. Optimus showed massive improvements in dexterity movement on 1010. I thought it was actually really funny that he said Optimus showed massive improvement on dexterity movement. Yeah, because we know we didn't get to see autonomy on Robotaxi Day or iRobot Day, We Robot Day, whatever. What we saw was human-controlled robots, and we did see fantastic dexterity, which I covered in my live stream as well. I'm like, yeah, this looks really, really good. It shows the function, but these are all human controlled. That should be obvious at this point. I also think the FSD vehicles were, on their own version of FSD. We already know they were on better hardware, way overbuilt hardware, but I think they were basically on a pre-programmed path, and this was really like a Disney World ride, which, forgive me, I just came from Disney World. We had a wonderful time, by the way. We did a VIP tour, and we did all 4 parks in a day. I don't recommend that. We got all of the great rides in, but it's a little quick. Dang, though, that Guardians ride, really solid. Really, really, really big fan. And if you haven't seen yet, not sponsored, Universal, the new Universal theme park in Orlando, Florida is opening Memorial Day. And I already pre-ordered tickets to be there like ASAP when it opens. So I'm kind of excited for that. I have a big theme park fan. But anyway, let's get into numbers and valuations here. So this is all overall very exciting. And I don't know where I stand with Elon's 20 to 30% growth for next year, especially with some of the pain that we're seeing in Europe. And I think some of that pain is going to extend to the United States. Now, don't get me wrong, I know Volkswagen is legacy, but Volkswagen is echoing what Tesla is also seeing in Europe, which is a warning that, quote, the car market in Europe is stagnating and will not recover in the foreseeable future, and that there is a worsening economic situation in Europe. And when you combine that with what I think is coming for the United States and really what's going on in China outside of the stimulus that's going on, I'm not the biggest fan of the global economy and some of the valuations where things are, but let's just actually get to some of the sheets and numbers and understand where valuations are. So we're going to do a few things. The first thing that we're going to do is I'm going to show you the spreadsheet. We're going to go through this spreadsheet in a moment. But before I hit the spreadsheet, I want you to have the Wall Street version. So the Wall Street projected next 4-year EPS growth rate is 29%. Now that could be low, but basically if you take earnings per share at the end of 2024 and you look at the next 4 years, you have a 29% growth rate in earnings per share projected. If you look at Tesla's current PE ratio, price to earnings ratio, it's at 112. That's simply today's price, like 270 divided by, 240 or whatever the end of year estimates are for EPS. So that means your PEG ratio right now is 3.87, which is really, really high. Based on Wall Street's projected next 4 years, if Tesla is a software company, I think their fair PEG would be 2.69, which gives them a fair value today of $187. If they're a manufacturing company, they have a fair value today at a 1.69 PEG of $159, which means, yes, there is a lot being priced in. Now, if I go to the end of next year as a manufacturing company, I'm at 159 on a PEG basis. If I'm a software company at the end of next year, I'm at 251. So we're still pulling forward a lot here. That's based on Wall Street's numbers. We're going to go into my spreadsheets, which helps solve for some of this in a moment. But that's based on Wall Street's numbers. I think this is Tesla pulling forward software-like valuations, but also, frankly, you're really pricing in Optimus and autonomy and probably more energy growth than is already being priced in. And I'm putting in a lot of energy growth in this already. So do consider that. There is a lot of enthusiasm being priced into this. And so if you've been really, really happy with what's been going on with Tesla lately and you want to diversify just a little, I'm not saying you have to sell everything. I'm not even making any recommendations to you. I'm not a personal advisor for you unless, of course, you hire us over at stockhack.com. But if you do want to diversify, consider the 5% convertible bond over at HouseHack because you get all of the upside in the stock, and you get downside protection, and you get paid 5% interest every single year for a minimum of 5 years. Now, this video can't be a solicitation, and that offer does expire December 13th, Taylor Swift's birthday. Probably coincidental. But anyway, go check it out at househack.com. Okay, now let's go through my valuation. And I want to be clear, this reconciles some of the Wall Street problems. So I'm not as much of a bear as Wall Street is. I actually consider myself pretty excited for Tesla. Okay, here we go. $40,000 per average vehicle selling price. That's roughly where we sit now. We're going to go with 3 million vehicles produced. This assumes the best case of Elon's best case scenario, because he said 25 to 30% for the next 2 years compounded. So that gets us from about 1.9 million vehicles to about 3 million vehicles, not including any Robotaxi vehicles in this estimate. I will in the 2027 estimate. I include $18 billion for energy. Keep in mind, right now on energy, we're at about $2.3 billion per quarter. So it sits about 9.2 per year annualized. That sits about 18, would be about a double in 2 years. Okay, very, very generous, I feel like, on energy. And that's high margin, very high margin on energy. I'm going to go with 18% vehicle margin. I think that's generous because I do think we're going to see higher FSD. I do think we'll see probably stable energy credits, worst case a little lower, but I do think that prices will come down. So I think 18%, we're around 17% X credits now, 20% with credits. I think 18% is reasonable. 31% gross margin on energy. Let's assume they keep that. Services, leases, these are nominal. I'm including FSD revenue in vehicle over here, so I've moved that up here. No Robotaxi income or fleet income or anything like that. OpEx, leave it at 6%. Okay, fantastic. So this brings me to almost $5 of EPS, which is about 80 cents more than Wall Street estimates for 2026. So my price targets are going to be higher than where Wall Street sits. So for an auto business, with my earnings per share at the end of 2026, I put this at a $248 stock. Well, since the price of the stock today is about $270, that does give you over the next 2 years about negative 4% compounded annual rate of return of invested return. Obviously not great. It basically means you fully priced in through the end of 2026. However, if you don't give them a 50 PE ratio, which is basically taking the growth rate of 29% times 1.69, which gets you to 50 PE. That's for automotive and manufacturing. If you go with the software side, which is taking a 2.69 PEG ratio, multiplying it by their growth rate of 29%, you get to 78 times multiple. If I change this to a 78 times multiple, you get to 388. That's where the money is. Look at that. 19.9% growth compounded over the next 2 years with a price target of 388. That's actually pretty sexy. That's pretty good. Now, I personally would put my base case at more of a 50, and I'd rather buy it at a discount to that. Now, no guarantees we're going to get that, but there is a chance that in the face of regulatory hurdles or any kind of hiccup or some kind of recessionary fear or shock, there is a case where you do get a sub 200 shot at Tesla again, and that's where you're going to start building in your margin of safety. Now, no guarantees that could happen, but that's where you build in your margin of safety. In fact, maybe even sub 150. Now, again, I know this sounds crazy, and I'm not saying this is going to happen, but what I want you to see is let's assume no vehicle growth for a moment. Kill the vehicle growth because there's a recession or whatever, and leave the energy growth and some of the other factors. But now all of a sudden, if I go 150 and I assume automotive margins, well, 150 still gives me 10% growth in the worst case scenario over 25 and 26, assuming we stay flat with vehicle deliveries. So that's really where you want to be if you really want to be more recessionary bear case, right? Okay, now let's go 2027. Now this is fun. So I reduce the revenue per vehicle to $35,000 here, and that's because you introduce the Robotaxi vehicle, which they then sell to consumers rather than running as a fleet themselves. It's easier to run the math this way. I go with a $25,000 car, I leave margins the same. However, I do reduce the revenue per vehicle because we have a $25,000 car. I assume 1 million vehicles by the end of 2027. This could be 2 million, but I'm going to go with 1 million. This assumes regulatory approval as well, and I give a little bit more of a boost to energy as well. I bump it to 20 billion. Okay, same margins over here, 18%, 31% on energy. Operating expense goes up a little, as is natural with the higher income. And so what I get over here is $5.76 of EPS for the end of 27. At a 50 for automotive margins, I get this stock to about 287, which doesn't give you much upside from where we sit today. You really have to price this company as a software company to get upside from today. If I pump this to 78, that's when you get to the 450 price target. There's that 19% compounded annual rate of return continuing for another year. So again, to really see the substantial upside from here, you have to price the company as a software company, and you have to assume perfection in execution and that regulatory approval. I do think those things are risky because I don't think we're going to get that regulatory approval as quickly as a lot of folks are hoping, and I do think we still face substantial recessionary risks. And so I personally think the valuation is on the high side right now. And again, I'm looking for more of a manufacturer's PE ratio, which if I go into a recessionary mode here, let me go ahead and pull off the, I'm going to go flat on the regular vehicle growth. So I'm going to go 3 million, drop that here to 3 for more of a recessionary model. I'm going to go with 50 for 2027. I really want to be sub 230 for my 27 model. So recessionary case, for 2026, I want to be sub 150. For 2027, I want to be sub 200. Non-recessionary, best case scenario, Elon growth mode. On the automotive side, hey, I want to be certainly sub 230. And over here on this spreadsheet, if I go back to that 3 million in growth over here, I want to be on the automotive side, ideally under the future value here of 248, where I'm actually getting a return, so probably closer to 200. Again, excellent work here in Tesla. They've done some great work in selling the vision of the future of autonomy. You really have to believe that the future is autonomous to go all in here. And the future's pretty good. I have to say, I think they are on the right track. Like, there will be autonomous vehicles in the future. The question is, are they going to be in 2026 and 7, or are they going to be in 2030 or 2035? I don't know. I bought a Tesla in 2017, and it's been 7 years, and we're still not full self-driving, right? We are way closer than we were in 2017. But if we were 85% of the way there in 2017, maybe we're 98% of the way there. It shows you the vast slowness. I mean, even Elon's now saying it's hard to kind of keep training the model because we're running out of issues to solve, but we're still not fully autonomous. So on one hand, it's sort of like we're close, but on the other hand, it's kind of like, yeah, but we're not. So it's interesting because the edge cases, those are going to be the ones you have to perfect to really get the regulatory approvals. So we'll see. But anyway, I have to say, overall, very, very impressive. Elon, it was a great call. It was a great vision that was painted on 1010. It was a great demonstration. I know the robots were remotely controlled, and I know I believe the cars are on their own sort of new, pre-programmed software. That's fine. The vision was beautiful, and that's what's being priced into the stock right now. I also think there was a massive short squeeze, and they might pull it off. Frankly, if anybody's going to pull it off, I think Tesla will pull it off. Anyway, thank you so much for watching this video. I'm going to add a quick note here on HouseHack. Just keep in mind, yes, HouseHack, it's not a car company. So while I compare to Tesla's convertible bonds in 2014 that paid 0.25% in interest, and yes, we're paying 25%, we're paying 5% over 5 years. That would be 25%, not compounded, right? But we're paying 5% per year. Think about it this way. We're a company that buys homes, we renovate them, we rent them out, and then after we've held them for a few years and we get to where we can exchange them to avoid paying taxes, we can flip them. Flip them on the open market, flip them to institutionals, flip them to funds, whatever. When we realize that profit, we do it again and again and again. as our properties hit that 2-year mark. So that way they're renovated, they're stabilized, we can lower expenses, we're real estate brokerage on top of that. And basically, we milk money by not paying taxes. So consider that for our model for House Hack. That's the really quick elevator pitch. And if you're interested in investing in that upside, or if you have questions, email us at ir@househack.com. Otherwise, consider that 5% convertible at househack.com. We've got a non-accredited round coming as well soon, so stay tuned for that. That's probably still about 60 days out, maybe closer to 90 days out. It's in attorney and SEC world. We're working on it. I don't want to forget about the non-accredited investors as well. Thanks so much for watching this video. I'm glad to be back, and we'll see you in the next one. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.